Stop what you're doing. Seriously, if you own or even follow HNI Corporation, you absolutely need to see this breakdown. Welcome to the Explainer. So last week, I ran HNI's brand new Q1 2026 earnings through 5 different valuation models, cross-referenced the data with Warren Buffett's and Peter Lynch's personal checklists, and honestly, what I found completely shocked me. Because at first glance, we are looking at a classic retail investor trap. You know the exact pain point I'm talking about, right? We all know that awful sinking feeling of holding a stock through earnings, seeing a massive headline-grabbing revenue beat, and then watching the numbers inexplicably unravel because of confusing accounting losses. It's enough to make anyone panic sell. But here's the thing. By the end of this explainer, I promise you'll have a clear, actionable framework to cut through the noise. You'll know exactly if this workplace furnishings giant is a legendary Buffett-style value buy hiding in plain sight, or a classic Lynch trap waiting to crush your portfolio. Okay, let's jump right in. Here is our roadmap to decode this madness. We're going to hit the Q1 headline paradox, peel back their recent acquisitions, dive into their aggressive cost-cutting strategy, check on the foundation of their dividend, look at their ESG progress, and finally, map out the outlook for 2027. Let's go. Section 1, the Q1 headline paradox. Now, I really have to acknowledge the initial shock a lot of folks felt when these figures first crossed their screens. HNI posted a top-line revenue surge of 125% year over year. Think about that for a second. We're talking about $1.35 billion in revenue for just the first quarter, compared to a little under $600 million the prior year. That is a staggering, massive jump that would normally have Wall Street throwing a parade. But then you look a little further down the income statement, and you hit this totally jarring contrast. Despite pulling in that massive $1.35 billion, HNI posted a GAAP net loss of $38.8 million. That translates to a negative 55 cents in earnings per share. Which brings us to our bold question of the day. How on earth does a company more than double its revenue, rake in over $1 billion, but still end up losing money? It's a paradox. It's exactly the kind of thing that causes amateur investors to panic and hit the sell button. But we don't panic here. We investigate. So let's get into Section 2, peeling back the acquisitions. To really understand the why behind this crazy paradox, we have to look at the massive strategic moves management has been making behind the scenes. HNI has been on an absolute tear, integrating the giant Steelcase brand. So that 125% revenue spike we just talked about, that wasn't just organic growth. The Steelcase acquisition alone added roughly $774 million to their workplace furnishing segment. But here's the catch. Acquiring a giant like that comes with massive one-time integration costs and hefty accounting charges. It completely warps the surface-level GAAP data. It's like buying a fixer-upper mansion. The curb appeal looks rough while you're renovating, but the actual bones of the house are totally solid. And this comparison right here is absolutely crucial. When you strip away all that messy one-time integration noise and those restructuring charges, you get the clean, non-GAAP figures. On an adjusted, purely operational basis, HNI actually generated a positive 34 cents in earnings per share. So not only were they profitable operationally, but they actually beat internal expectations by offsetting macroeconomic softness with incredibly strict expense control. It's a totally different story when you look under the hood. Moving on to Section 3, the cost-cutting strategy. Listen, management isn't just sitting back hoping these acquired companies magically run themselves. They are making some really tough, bold choices. First off, they decided to completely terminate the multi-year Steelcase ERP software project. This was a smart move to avoid throwing good money after bad and to prevent customer disruption. Second, they're heavily optimizing their legacy manufacturing network. Now, this includes the really difficult decision to close their Wayland, New York facility by 2027. But altogether, these moves mean they are targeting a massive $30 million in optimization savings over the next 3 years. So the whole point here is weighing short-term pain against long-term gain. Yes, the Wayland closure comes with an estimated $14.9 million in pre-tax restructuring charges spread out over 2 years. And unfortunately, it does involve the loss of 135 jobs. But financially speaking, this shift is going to permanently generate about $7.5 to $8 million in annual savings once it's fully mature. They're ripping the Band-Aid off now for a leaner future. All right, Section 4, the dividend foundation. For all of our income-focused viewers out there who might be wondering, hey, does all this restructuring put my payouts at risk? Well, the numbers speak for themselves. HNI is currently offering a really strong 4.36% dividend yield. That's $1.36 per share annually. And management has explicitly stated their steadfast commitment to maintaining this payout, even as they navigate some softness in the residential housing market right now. And they aren't just maintaining it, guys. They're actually growing it. Look at this steady history of quarterly payouts. We see it progressing from 32 cents a quarter back in 2023 all the way up to their recently announced 35 cents per share for June of 2026. This dividend isn't an afterthought. It's a bedrock financial element for the company. They are prioritizing rewarding their shareholders. Next up, Section 5, Sustainability and ESG Progress. Beyond just the sheer financial resilience, HNI is actively minimizing long-term risk through corporate responsibility. And the results are pretty wild. Compared to their 2018 baseline, they've achieved a staggering 78% reduction in Scope 1 and Scope 2 emissions. This was driven heavily by procuring renewable electricity and upgrading efficiency. It places them way, way ahead of their near-term targets. And they are redefining their material selection and packaging in very tangible ways, not just greenwashing. 60% of their manufacturing facilities have now officially achieved zero waste to landfill status. That is huge. They've also completely eliminated expanded polystyrene, that environmentally persistent foam packaging, across all their manufactured products. Plus, they launched the EVO Carbon Neutral Task Chair. Remember, these aren't just corporate buzzwords. These are structural, operational changes that drastically reduce future regulatory liabilities and lower long-term material costs. Finally, Section 6, the outlook for 2027. Okay, we've seen the messy headlines, we've broken down the integration costs, and we've analyzed the efficiency gains. So where does this all lead us? It leads directly to this extremely exciting number, $120 million. That is the total expected synergies from the Steelcase integration alone. When this fully matures, management expects it to drive $1.20 in earnings accretion per share. That is going to create an absolutely massive engine for cash flow. I want to read you this really powerful piece of guidance straight from the earnings transcript. HNI projects double-digit EPS growth in 2027, driven by synergies from Steelcase integration and legacy network optimization projects. What management is basically signaling here is that all the heavy lifting being done right now, the proactive pivoting, the painful network consolidation, it's all setting the foundation for multiple years of highly visible, elevated earnings growth. So I want to leave you with this to really think about. Is the short-term restructuring pain and the incredibly messy gap headlines we are seeing today worth the promise of double-digit earnings growth tomorrow? It's the ultimate classic investment tension between surface-level numbers and underlying operational strategy. Definitely keep an eye on how effectively HNI executes this massive integration over the coming quarters, because it's going to be a fascinating transformation to track. Thank you so much for joining me on The Explainer, and I'll catch you guys in the next one.